Welcome to the Drive to 850. I'm Al Bingham, and I'm here to help you improve your FICO credit scores. Today is a really good podcast. We're going to talk about something that isn't discussed that often out there on the internet. In recent podcasts, we've talked about some of the credit score improvement programs available to consumers. Today's podcast is specifically going to target 3 supposedly self-referenced credit score improvement programs called Lyft, Chime, and Self. Do they really build your credit score? I've come across these accounts with different consumers. And there's some critical information I'm going to share with you. You're not going to find this anywhere else because people don't understand how the FICO credit score works. In previous podcasts, I've referenced that FICO credit scores look at different types of accounts and also different types of lenders. Now, this is exclusive to the FICO credit score. And unfortunately, most consumers don't realize that different types of lenders can have a huge impact on your credit score. They can increase your credit score to levels of 800 and above, or they can basically handcuff your credit score and hold it down. You say, how's that? It's true. Different high-risk lenders hold down a FICO credit score. And it's tough for consumers to recognize that because FICO doesn't share this information. But we've come across this. And I'm going to share this a little bit further in a second. I referenced 6 critical points to help all consumers improve their FICO credit scores. Remember, the first one is to get a copy of your lender's credit report and 3 FICO scores, specifically the classic FICO credit scores. Second, we need to do a complete analysis of the credit report and credit score. Know where you're at, what you need. And in most cases, you don't need a whole lot. It's just making changes to your credit report that can enhance your credit scores and basically maximize them. And then I identified 4 critical questions. Remember, the first one is accounts to open. Second is accounts to close, accounts to keep open, and accounts to pay down. What Chime, Self, and Lyft all do is they open a credit account in your name. They think by opening an account in your name that they can help build your credit scores. And that can be true, but to a limited result. You'll never know this until you listen to this. So let's start with the first one, accounts to open. So Chime, Self, and Lyft go take your credit report and they open an account. There's a new inquiry in most cases, and a new account shows up. Now, oftentimes, after an account shows up in your credit report, FICO scores will drop. Not always, but in many instances it will. Problem you have with Lyft, Chime, and Self is they're basically coming to you telling you that they're going to build your credit scores. In fact, let's go to Self. Self says, build credit, build dreams. Ready for liftoff? Customers who make on-time payments can see an average credit score bump of 49 points. Let's look at the details in there. It says, average outcome for customers who opened a 12-month credit builder account in quarter number 1, 2021, starting Vantage Score 3.0 under 600 who made on-time payments. Other factors, including activity with your other creditors, may impact results. So what they're referencing here is that the 49-point improvement impacts your Vantage credit score. Now, you may recall in the previous 2 or 3 podcasts How many lenders use a Vantage credit score? 0. To underwrite and approve your auto loan, your mortgage, credit card, there's no one. So I call this out on self. It's not anything of worth to any consumer out there. Nothing. So that 49-point improvement, who cares? It's like taking the practice SAT or ACT exam and seeing a 10-point bump. Do you think that matters to colleges? No. They want the real ACT or SAT score. So that's a problem. So self is telling you something that really has no value to you or to anyone, to any lender, to no one. So who cares if their credit score improved 49 points? Doesn't matter. Let's go to Chime. Chime has those fancy commercials. Remember the couple that gets married and has a baby and they got to establish credit? They open up a Chime credit card. That's great. Let's look at it. It says, upgrade your account with Credit Builder. Start improving your credit score by 30 points on average with regular on-time payments. Help build credit with everyday purchases. No annual fees, interest, or minimum security deposit. No credit check to apply. But let's go further down into the terms, something they don't want to share with you. It states, credit score increase is based on a representative study conducted by Experian members who made their first purchase with Credit Builder between June 2020 and October 2020. Observed an average FICO score 8 increase of 30 points after approximately 8 months. On-time payment history can have a positive impact on your credit score. Late payment may negatively impact your credit scores. Now let's come back. Remember we talked about the FICO 8 credit score? Do mortgage lenders use the FICO 8 credit score? No, they don't. Do auto lenders? No, they use the FICO 8 auto score and the FICO 8 bank card score, but they don't use the FICO 8 credit score. Now you can go back to the previous podcast when we talk about these different credit scores. So again, is there any value to you as a consumer? Not really. I mean, it's helping out a FICO credit score. Maybe it's the sister to the classic FICO credit score, but it's not the classic FICO credit score. So again, does it really have any benefit to you? Very little. There's a bigger problem here, and it's something that we have come across, and we reference Self, Lyft, and Chime. Now, FICO looks at different types of accounts and lenders in your credit report. It's very exclusive to FICO credit scores. One of the negative factors that can impact a credit score is a high-risk lender. They call them finance companies. The reason code number 6 will show up and say, it will state in the credit score, the FICO credit score, too many finance companies. What is a finance company? A finance company is a high-risk lender. It's a standalone company usually. It's not a bank or a credit union. They offer other financial services, more on the consumer side. Maybe the 90-day, 180-day, same as cash options for several retailers. Or they could be the company that goes in and finances an auto loan for someone who has maybe less than average credit. So how does it impact a consumer? A finance company will impact a FICO credit score for up to 10 years. How much? It's generally between a 12 to 16 point decline. So instead of having maybe a 640 credit score, you have a 625. Instead of having a 680, a 665. 720, a 705. 760, a 745. An 800, 785. It drops the credit score the entire time it's on the credit report from the last time you made a payment for another 10 years. Not 7, such as late payments, it's 10 for finance companies. Why is it 10? Because credit agencies keep the accounts in our credit report for up to 10 years after our last payment. Now, late payments can appear in our credit report for up to 7 years. But different accounts, they can stay on our credit report for up to 10 years. Now, if we've had late payments 8, 9 years ago, those late payments will no longer show up after the 7-year period. But they will continue to remain on a credit report for up to 10 years. So it's like having 2 or 3 hard inquiries on your credit report for 10 years. That's the impact. So it can easily drop you a grade on an auto loan, on a mortgage, on any type of loan that you go to qualify for. On an insurance premium, you bet. So how do you tell a finance company? This is the toughest thing. How can I tell? I look at the reason codes. So in Chime's situation, we noticed a couple borrowers who had a Chime credit card, and the reason code showed up showing as a finance company. Now, it didn't show across all 3 credit agencies because they can vary in how they define different lenders. Maybe one can be a regular lender, but one could be a high-risk lender. So they're inconsistent in that regard. But once a finance company shows up, I always tell everyone anywhere, if it shows up with one credit bureau, consider it showing up across all 3 credit bureaus because you don't want it impacting any of your 3 FICO credit scores for 10 years. So Chime is listed as a finance company. Same with Lyft, same as Self. Yes, you can build your credit score, but instead of building at 50 points, you're only building at 35 points. Or instead of going up 100 points, it's 85 points. That's just from one account being open. Now, if you have multiple Self or Chime or Lyft or other finance companies in your credit report, it can impact your credit scores even further. 25, 30, and 40 point drop. Even if you made payments on time, it doesn't matter. It's solely looking at the type of lender you're going after. That's why I always tell consumers when you're trying to build credit, you want to go to an established bank, national credit card companies such as Capital One, Discover Card, someone like that, or a credit union to get your first credit card or to reestablish credit through that institution. Don't go off after these one-timers who only offer credit card services, because it can come back and hurt your credit score for years, and you could pay thousands more because of it. A couple of years ago, I wrote in the blog, the one mistake that consumers can make that can impact their FICO credit scores for 10 years. It was read by thousands and thousands of people. Now, this is one point I bring up to you, and no one understands this, even your credit counselors, your educators, and the information, unfortunately, out there on the internet. They don't understand this issue here. I'm telling you straightforward what's happening here. I would not open an account with Chime, Self, or Lyft to reestablish your credit or to build credit. I would go to a bank or credit union or national credit card company. You can go into this blog, and I'll give you the link here so that you can identify and understand more fully what I'm referring to, because it can have a real substantive impact to your credit scores. And you don't want to drop your credit scores 15 points for 10 years and even longer. If you have one of these accounts open, I'd close it. I'd pay it off and close it. and I'd go establish a new account with a reputable institution, a bank, national credit card company, or credit union. This is one of the misnomers and misinformation that's out there on the internet. People think that just opening accounts with whoever will automatically benefit your FICO credit scores. It does not. So when you go in and you open a credit card account, does it open the right account? No, it doesn't. Chime, Self, and Lyft do not. Let's go to the second issue here. Does it tell you which accounts to close? No, it does not. Does it tell you which accounts to use? No, it doesn't do that either. Finally, does it tell you which accounts to pay down to get the biggest boost to your FICO credit scores? It doesn't do that. So the four critical questions, Self, Lyft, and Chime, fail to provide this critical information. It's like playing a dartboard game and covering your eyes and just throwing. Now you may strike it somewhere and go, oh, that's great. But you'd rather hit the middle every time. That's what we want. Don't play games with different types of lenders. Use reputable lenders when you need financing. Don't play around with this offshoot lenders that are there stating that they can build your credit scores. Now, they can build your credit scores a little bit, but you and I both want your credit scores, your FICO credit scores, to be maximized. We want to get the biggest and best point total we can at this time. Same thing for tomorrow, next month, and 2 months, and 3 months, and a year. We want to achieve the highest level possible. So when it comes to Self, Chime, and Lyft, I'll give them a D to a D minus. Sure, they can get some recent payment activity in your credit report, but it will do it at a heavy cost for you for years to come. So again, I would not recommend any of these three accounts to open a credit card. It's not worth it. On my next podcast, I'm going to talk about credit repair companies, what they do and what they offer. And we'll go through the same questions and show the results. I hope this has been helpful. Please like and subscribe to the Drive to 850. If you have any questions, please email me at thedrive850@gmail.com. And if I can help you with any mortgage loan, you can scan the QR code, and we're licensed in the following 10 states. We'll help maximize your purchasing power. Have a great day, and I'll see you on the next podcast. See you soon.